Well, thank you all for joining us for this focus session of our Global Development Forum to discuss building resilience to disaster risks by leveraging insurance. For those of you who missed my opening welcome this morning or who I haven't yet met, I'm Noam Unger, and I'm the Director of the Sustainable Development and Resilience Initiative here at CSIS. And to set the stage a bit before we enter into this conversation, in many emerging markets and developing economies around the world, people, businesses, governments, they're grappling with the mounting shocks and stresses posed by extreme weather. Poor resilience to such physical risks too often results in catastrophic losses of life and livelihoods, with significant spillover effects such as cascading economic turmoil or even instability and population displacements. This all has effects on international business, trade, and supply chains, but it also connects to an emerging resilience economy that is ripe for investment. Meanwhile, it is quite an understatement, truly quite an understatement, to say that there are downward pressures on US and allied budgets for development and humanitarian aid, and a greater need than ever before for more cost-effective use of public sector de-risking capabilities to incentivize and leverage greater private sector investments. It's within this mix of factors, and probably many more that'll come up in the course of our conversation, that it feels both important and very timely to discuss the multiple ways that the insurance industry and associated public policies can advance critically needed resilience and development investments in developing country contexts. So we're going to unpack this set of issues and more with a wonderful panel discussion. And I'm joined by 4 key leaders, and I'd like to welcome them by introducing each of them in order. Ekosue Yahen is the Secretary General of the Insurance Development Forum, a truly impressive public-private partnership that brings together leaders from across the insurance sector. She has deep experience working on public financial management, risk management, and insurance matters with the private sector, governments, and international development agencies. Welcome. Leslie Ndlovu is the CEO of the African Risk Capacity, a specialized agency created by the African Union and focused on sovereign disaster risk solutions through risk pooling and risk transfer services, married with capacity building and contingency planning services. He was the former CEO of AXA, Africa Specialty Risks, and has extensive international experience across the corporate finance, audit, tax advisory, insurance, and investment management sectors. Welcome. Bridget Gaynor is the Global Head of Public Affairs and Policy for Aon, a professional services firm with deep expertise in risk mitigation, insurance, and reinsurance. Her division of Aon focuses on developing innovative solutions to help governments and other institutions reduce volatility and increase resiliency. And Bridget leads Aon's engagement with governments around the world. Thank you for joining us. And Benedict Signer is the Executive Director and a board member of the Southeast Asia Disaster Risk Insurance Facility, CDRIF Insurance Company. He has deep experience in disaster risk finance, including more than a decade at the World Bank, supporting countries managing potential losses from climate and disaster shocks across Southeast Asia and other regions. So each one of you on this panel has been closely involved in the creation and implementation of multiple risk financing and insurance initiatives globally. So I'm particularly excited for this conversation that we're about to have. Let's use this opening round of comments from each of you as an opportunity to further introduce your organization and the lens you bring to the discussion, and then we'll get into some further questions. Ekosue, I'd love to begin with you.
Okay, well, thank you first and foremost, Noam, for the invitation. It's my first time at the CSIS, so it's really great to be here and to meet so many people, and also to be hosting a session on insurance. So really appreciate that. As you mentioned, I represent the Insurance Development Forum. It's a public-private partnership, but led by the insurance industry with international organizations, specifically co-chaired with the World Bank Group, as well as the United Nations Development Program. It has its genesis really in, I think, part of the concern that emerged many years ago when you look at the experiences of many developing and emerging markets dealing with shocks, if it is tropical cyclones, if it is droughts, etc., and an interest on the public sector side, the multilaterals, to really try to tap into how can we or how can they better work with the insurance industry to address some of the issues that they were seeing already that many of these countries were dealing with. And so the IDF was created as a vehicle where you could efficiently bring global and also local insurance industry together with the public sector to really try to identify where are the areas where we can make a material difference when we think about the issues that many developing and emerging countries are faced with. And with that point, I think one of the important things that is worth mentioning that perhaps not everybody is aware of is that in many emerging developing countries, we are talking about markets where you have 1% to 2% insurance penetration rates. So what does that mean? That means that when you have a disaster, there isn't necessarily the kind of protection systems that exist to allow governments or people to cope with these shocks. And so there is a real challenge in terms of how do you build better insurance markets. But it's not just simply about products. It's about how do you build better systems that can understand risk, manage risk, and drive the innovation of products and systems to actually create more resilience. And so for us, our work is really about bringing those capabilities from the industry with the public sector to figure out what we need to do to address very pressing and difficult issues. And frankly, many of the issues that we've been engaged in, we are seeing it more and more in more developed markets, right? You're seeing more floods, more droughts, significant populations who do not have access to protection. So I do think that this is an issue, yes, in the context of the IDF, we focus on emerging, developing markets, but it's a global challenge currently. And I think that there is a lot of innovation and collaboration and actual work and scaling that needs to be done in this space.
Well, thank you for that. Leslie, why don't you share with us a little bit of your angle on the topic?
So the African risk capacity was created in 2012 by the heads of state of the African Union. And the mandate and the mission is quite simple. We are witnessing an increasing frequency of and severity of natural disasters. And there's the need to then create a better system for financing the cost of the natural disasters. Before the creation of ARC, the standard approach was that you would wait for a disaster to happen, and once it happens, then figure out how it's going to be paid for. So what we have done with the African risk capacity is to bring together the best elements of the private sector as regards the measurement, the understanding, and the pricing of risk via an insurance program with the scale and the reach of the public sector. To illustrate this then with a few examples, in Africa, we are providing insurance to over 30 million people every single year. And we provide the insurance programs through governments. So for example, I live in Kenya, and the government of Kenya then takes out an insurance policy. If there's a drought or there's a flood or there's a tropical cyclone, then we pay a claim to the government of Kenya, thereby allowing them to very quickly and effectively respond to the cost of natural disasters. The second segment that we're working in is the humanitarian NGO sector, because they are also faced with the same challenges that governments have. So in the aftermath of a natural disaster, these organizations have to scale up their level of activity in the countries, and the cost of scaling up can then be financed by insurance. Then finally, we also work with small to medium scale farmers to deliver micro and meso insurance solutions. All our insurance solutions are underpinned by parametric insurance, so we rely on satellite data, including data provided by the US government via the NOAA agency. And using that data, we're able to then model out what the risk of a drought or a flood is in a particular area. And indeed, also once that occurs, we're able to work out what the severity is. The advantage of using this innovative approach relying on satellite data means that our insurance programs are then hyper-scalable because we don't need to have boots on the ground in any particular location. but if we have access to the data, we can create the insurance programs. Also, it comes with a high degree of transparency, because then everyone has also access to the data that we've used to calibrate the severity of a drought. And if you're so inclined, you can then recalculate yourself what you believe the severity should be. Having this proactive approach to how disasters are financed is extremely important, because it means that when a natural disaster happens, we can all focus on the best outcomes from implementing, and not wondering and scratching our heads about where the fund is, then the protection gap. And it's all underpinned by best practices from the private sector in terms of the way we are working and analyzing the risk, including with working with organizations like Aon, and we'll hear from Bridget shortly. And this creates then an extensive and integrated approach to disaster risk financing.
Wonderful, thank you, Leslie. Well, that's a good segue, actually.
There we
Bridget,
go.
over to you and to Aon.
So Aon is a broker of risk and insurance. We're an advisor, and I think I'll just pick up on the comments about data and the importance of data. Over the last, I've been at Aon for 24 years, and so I've seen the company evolve, and I've seen the industry evolve. And the basic elements to insurance are information, and then capital, and then the relationships to put those two things together, which is trust. Some of it is the organizations like Equisway runs to create the coalition building opportunities. But I've seen over time that the relationships used to be primary and the data was important. And now it's gone the other way around, where relationships are of course very important, but the amount that we can measure, the amount that we can see and find, and you mentioned the getting the transparent data from NOAA. I'll just put a plug in that we're only as good as the information that we use, and so companies like Aon have the ability to attract capital to risk, to manage volatility, but they can only do so with trusted and transparent information. And so I think, I know we'll get into it later, but some of the cuts and other things that are happening at NOAA now, where it may impair the ability to have transparent data that globally everyone agrees on one set of facts, is both troubling, but something we as an industry need to be really clear about standing up for and standing up to. So, Aon's in 120 countries. We obviously work in every continent, and I'm thrilled to be here. We are also a very proud member of the IDF.
Great, thank you, Bridget. Benedict, same question over to you in terms of the lens that you bring.
Yeah, thank you. One of the simplest introductions for me here now, following Leslie, is with the ARC version in Southeast Asia, but given very different context, continent, environment, also very different challenges and opportunities. But if you think of, if we're convinced that insurance has a positive role to play, as I think we all are, we think of what are challenges to access to insurance. I'd say we have affordability is a big problem often, availability and access. So does a market exist? Is it affordable? And what's the friction to actually putting those two together, demand and supply for insurance? In Southeast Asia, I think quite different from Africa, maybe Pacific and some Caribbean islands, the challenge is less affordability. Depends country to country, but you have very big economies. It's definitely not availability. There's strong insurance markets, international insurance markets. Aon is obviously in Singapore, across the region, but also domestic insurance markets which have grown times 20, 30, 40, 50 years. And there's increasing demand. A lot of governments, public decision makers, they're getting quite aware, especially the finance ministers, financial decision makers, and they're looking how can they better manage the risk from increasing risk from disasters. And risk is growing very rapidly with increasing exposure, right? This country's investing very heavily in infrastructure, in urbanization, just putting things on the ground that then are in harm's way. But the problem is those two are not necessarily closing. There's a big market failure. There's strong supply of capital, there's strong supply of expertise, and there's demand for it, but the two are not taking off. Like the closing of the protection gap, to use this example, is so slow that we see pilots that take 5 years that are fantastic in their own right, but we don't have 5 years to see a small pilot to then replicate another small pilot somewhere else. So at CDRIF, what we see our role and also where we looking to define our role is how can we best bring those two together? How can we help governments bring more risk to market more efficiently, more effectively, and faster to scale up protection? So it's not necessarily about developing new products, because there's a vibrant private sector that does this, but it's saying, what is in between? What's stopping this, right? How can we reduce the friction? How can we reduce the transaction cost? How can we increase the trust? It's so important to make the market function better, faster.
So, having each introduced a little bit of your lens, I think for the audience it might be useful to sort of ground this a little bit in terms of some examples. So I'd like you each to actually answer this. Kosei, I'll start back with you. What specific community or society level examples come to your mind to illustrate how insurance can tangibly build resilience to disaster risks?
So I think, both Benedict and Leslie give some really good examples in terms of risk pools, but I could perhaps offer maybe a program that we are working on within the IDF. I'll give two insights. One is, we talked a lot about data. We talk a lot about data, but is that information available to ministries of finance to make the kinds of decisions that are needed? And oftentimes we see that there is significant scope for improvement in terms of the provision of basic information, risk information that governments can have to make difficult choices about. And a few years ago, when we attended one of the conferences, what's called the V20 group of countries, which is 68 of the most vulnerable countries, approached the IDF to say, can we work with the insurance industry to create a public-private partnership where you can support us in terms of building out some of those capabilities in terms of unpacking when we have tropical cyclones or droughts or whatever the case might be. What does it mean in terms of impact on government's national budget? What does it mean in terms of impact on households, right? And using that information to inform not only their decisions at a national level, but also conversations that they're having with international organizations in terms of their development ambition. And I cite this as an example because when we think about insurance, oftentimes we don't think about the capabilities that inform the development of these products. And those capabilities are incredibly valuable, right? And they have a function beyond simply the underwriting the products, which themselves are of significant value. So I cite that as one example. Another example is an initiative that we launched with the UN, again, working with over 20 governments around the world to address very specific risk transfer questions. So we have, for example, a project in Peru that came out of the 2018 floods from El Nino, significant damage to infrastructure, schools, roads, etc. And the government was interested in how do we design an insurance cover for public schools, 50,000 public schools. And so part of the work that we did was to say, okay, let's look at what an insurance cover could look like, but let us help them to also develop a database of what does that infrastructure stock actually look like. Because they're interested in thinking about how do we actually improve the quality of that infrastructure. That's one example. It's very practical, right? Another is in Mexico, where the government was very interested in the fact that, they could afford premium, but smallholder farmers, no access to insurance. And there was this interest in how do we ensure greater financial inclusion of these communities? How do we educate populations in terms of proactively managing their risks? So they approached the IDF to help them to design an insurance cover, but to also address some of the downstream elements around how do you actually reach people? Distribution, how do you get to communities? Who are the entities that interact with these communities? And insurance has a lot of value. It's not only on the risk modeling, it's not only on the writing, it's also about the connectivity to people, right? And I think that these are just some of the examples. And maybe a final one is, when we think about the industry, obviously there's risk assessment, there's underwriting, but insurers are also institutional investors, right? A third of assets under management globally is within the insurance industry. One of the things that we have been doing within the IDF is to really explore how do we get insurers to invest more in infrastructure in emerging and developing countries. And I think this speaks to many of the things that we're seeing emerging now, where countries are dealing with significant problems. We talk about public-private partnership, the availability of capital, the need for infrastructure. How do we unlock that, right? And so one of the challenges that we have taken on in the IDF is to explore how do we create a mechanism, a fund, which we have operational already, to increase those investments by insurers within these countries. And I think, again, that is part of demonstrating those capabilities that we've somehow taken for granted in more developed markets in terms of the development function of insurance. Its function in terms of shoring up societal resilience, financial resilience, and financial stability, right? And in developing emerging countries, those are systems that need to be built. And there's an insurance contribution within that context.
Sometimes I wonder, Ekoswe, if in the United States, our sort of global development community overlooks issues of insurance, in part because of how it's structured in the United States, where insurance is sort of regulated state by state, as opposed to at sort of a federal level. So people who are working on issues in the federal government sometimes aren't as keyed into the value of insurance, even to our own development and our own sort of economic growth in the U.S.
It's a good point. The reason why I thanked you for hosting this is not many people want to buy insurance. That's the reality. But they're either forced to, or they understand, okay, yes, there is this issue that I need to kind of manage. And it's also a cultural thing, right? So I do think that within the development community, historically, it's a little bit of an apprehension, a little bit of a neglect. But I think that we are now coming to a point that we cannot not engage, right? Or see the importance of how do we help governments, communities better understand risks. And I will go back to my fundamental point, is that this is not only an issue in emerging developing countries, we're seeing it increasingly in developed markets, right? So.
Yeah.
Could I make an intervention there?
Please.
And I don't want to be too provocative, but, you know, I think to some degree, there's a lot of the global development community and a lot of the government community that's really comfortable handing money to people and giving them things, whether it's deemed as a gift, a loan, a charity, whatever it is. And it's like, I'm here and you're in need, so I'm going to give you something. And that is very different from insurance, which says you need, the private market needs to be involved. There needs to be some sort of understanding of the risk. There needs to be a pricing of the risk. And in many cases, and I can speak about this later, that there is absolutely a public sector funding portion of insurance, but it is not a gift because there's too many other stakeholders that have to be involved in a way that is slightly more disciplined than I'm deciding out of my largesse to give you something.
Yeah, and oftentimes it's not even just the funding side, it's actually the regulatory, like there's a policy in place that one must have insurance to engage in activity X,
Fair,
Y, or Z.
but I think culturally there's a lot of comfort with handing people things as opposed to participating in a market of equals.
That's a fair point. Leslie, I'm happy for whatever you want to inject, but I also want to ask you what you use to sort of illustrate the resilience that is built up through ARC's programs in addition.
Right. So maybe I think building on what Bridget has said, the key difference between post-disaster grants and insurance is that firstly, the pricing of insurance is a lot more scientific because it's calibrated on the probability of the event. It's also calibrated on the expected size of the event. So this objective approach results in a more efficient allocation of capital than you would if you were just waiting for the event to happen. In addition, insurance has a leverage effect for the premium that you pay. In the event of a disaster, you get a multiple or a significant multiple on that premium. And it then also crowds in the private sector via the reinsurance markets. So if you are wanting to make grants, in fact, if you are making grants to pay for insurance premiums, you will have much better outcomes than you would if you're waiting for the disaster to happen and then make the grant at that point. If you think about it in another way, you are making a certain payment in terms of the premium in exchange for a certain payout in the event of a disaster. And from a planning standpoint, then whoever is the beneficiary of the insurance program also knows how much money they are likely to receive in the event of a disaster. And having this certainty of the funding also means that you are better able to plan and to prepare yourself. So this is also then an additional benefit. Coming back to the question that you're asking about tangible illustrations of impact, I'll just make two examples. So last year in Southern Africa, we had the most severe drought on record. What caused the drought was that for 1 month in the middle of the cropping season, there was no rain at all. Then also, it was the hottest temperature that was ever recorded, and as a result of that, there was complete crop failure. At ARC, we paid close to $70 million in claims that went towards helping 7 million people with emergency food aid. And in most cases, the claim that we paid was the first dollars that the governments received in order to be able to respond. We paid our claim within 3 or 4 days of the confirmation of the event. And of course, insurance doesn't cover the entire cost of responding to the disaster, but it provides then valuable liquidity while the government launches the international appeal. And of course, in this type of scenarios, the faster you are able to intervene, then the better the outcomes are, because then people don't have to pull their children out of school, start to sell their productive assets, or become then refugees in another country. So it really strengthens outcomes. Then maybe at a more micro individual farmer level, in Cote d'Ivoire at ARC, we set up an agricultural insurance program targeting the rice value chain. So you have farmers that grow the rice, and at the end of the chain, you've got the large agro-processors that buy the rice. And if there's a drought or a flood, then it's going to reduce the amount of rice that is available. And this is then a knock-on effect on the supply chain. When you introduce insurance, then you give an income guarantee to the farmers, because if there's crop failure, then the insurance is going to pay a claim which makes up for the income that they've lost. But also, you also improve then the resilience of the supply of the entire supply chain. So it again just illustrates how insurance then can support the income and the livelihoods of farmers. And what you see as a result of that is that farmers are more willing to invest in the productivity of their farms. Lenders are more willing to lend into the agricultural sector, because then there is a backstop in the case of natural catastrophes.
In that example in Cote d'Ivoire with the farmers and the rice, who or what constellation of actors pays for the upfront premium to enable all of those benefits that you're describing?
So you're making me relive the trauma of setting up the program. So it's a multi-stakeholder approach. So generally what you find is in cash crops, the farmers are already organized into large scale cooperatives. And this part is important, because then the conversation is not with one farmer at a time. It's with a cooperative that is able to act on behalf of the farmers. A big part of the production is financed by agricultural lenders who are providing inputs or extension type services. And they obviously have a financial interest, because if there is crop failure, then no matter how creditworthy the farmer is, if they have no income, then they are going to default. So what you end up seeing is that the lenders insist now that insurance be part of the program, and then it's paid for in part by the farmers. But in the specific case of Cote d'Ivoire, part of it was paid by the German government through KfW. And once you put all of these together, then the farmers realize then the value of the insurance programs, and this makes them in the long run more willing to spend their own money on the purchase of insurance, thereby ensuring that the scheme is financially sustainable for the long term.
Thank you for that. Benedict, an illustration that comes to your mind of, like, tangibly?
Yes, I can talk with tangible illustration, but I think what stands out to me, what's important is to bring together some of the little bits we heard here. That is very important. So it's maybe the most obvious part we think about insurance, the benefit is the payout that we get when something happens, the protection. Okay, let's put that aside, that is a clear benefit. Then we talked about the capital, the investment side, the assets of it, which is probably less commonly known but well understood for people who work on this. But then there's the third part, which I think most people don't often think about, and that's, and we all came through a bit, right? It's the insurance brings discipline, insurance brings transparency, and insurance brings predictability. Mm-hmm. Not just on the, I get a payout, but where does the payout come from? Right. How does it flow? Who does it go to? And that's as important for the beneficiary. And the beneficiary can be a homeowner, it can be me for my house, it can be a government department, it can be a farmer, whoever is the beneficiary. Right?
A business. Or,
it can be a business.
Yeah.
And likewise, though, for the government gets certainty to some extent that they know how money will flow. Right. They know the money will be used for the purpose it is intended for. And you can set up all of this in advance. You're building discipline across the whole economy. And that's in developing markets where it's not that existing, exactly the same in developed markets, right? The insurance drives this behavior change through the whole economy. I think what that's important to think, maybe slightly widen the conception or the concept of insurance we have. I think for most people, insurance, we think of commercial insurance markets, commercial insurers. But the insurance industry or the concept of it is much broader. We can think about self-insurance. We can think about mutuals. ARC is a mutual belief, right? Microinsurance. We can think about pre-arranged finance that leverages the expertise and the systems and the structures of commercial insurance markets in different ways. So how can we set up the money in advance, bring in the right expertise to build the transparent systems that you know where the money goes when something happens? And that last part, I think, is incredibly important for better outcomes. If I look at this from a development point of view, the payout of insurance is irrelevant. If the insurance pays out and money sits in a bank account for 6 months and nothing happens with it, it doesn't do any good. So how can you think about this part of how the money is being used when something happens? Now, in order to plan this properly, in order to depoliticize that decision-making after disaster, you need the predictability up front, right? You can make a good plan, but the insurance or the funding gives the teeth afterwards to say, how can you implement it well? You mentioned Mexico before, and Mexico had, been through some challenges, but a national system for a long time, a natural disaster fund, for which they bought insurance on top of it. So it was this budget allocation to pay out following disasters to the states, so the subnational level, for reconstruction of infrastructure. They then purchased insurance for a layer on top of it. So the first roughly 800 million was paid by the government budget and the insurance on top of it. A big purpose of the insurance was, sure, to pay when more severe events happen, to make it more cost efficient, but also to use the insurance as a way to make sure the money is going where it's supposed to go, and use the insurance, the private markets, as a way of providing transparency and discipline into the whole system. So you can bring in the insurance industry as a mechanism to level up the whole economic structures and risk management structures through the economy.
Well, and I think there's something to that sort of sense of a system and predictability and certainty is directly connected to confidence, which is also connected to issues of just sort of creditworthiness of individual, let's say, infrastructure projects or governments as a whole, right? So like there's this other sort of ancillary aspect that we can think of in connection to insurance. One thing I want to raise is, Leslie, I think you were the one who mentioned it. You said that ARC, all of your product offerings are actually index-based insurance, parametric insurance. And that's one example of innovation within insurance offerings. And there have been a number of different innovations, both on the product side, like that's how I think of parametric insurance as being a sort of a product side connected innovation, but also on the sort of structural innovation side. In fact, I think your institution is an example of an innovation, and CDRF is an example of innovation as well. So maybe we could talk about that, about some of the sort of innovations and evolutions that have come up over the last, I don't know, it's 10 to 20 years, because I think it's important to think about those rather than building something new. Let's build upon what's been created to scale it up. I don't know who wants to jump in on that. Everybody does. Ekosway, let's come back to you.
We're going in order. So yes, parametric insurance, it's I think quite an interesting innovation that has emerged. And I wouldn't take away from Leslie's thunder because yes, ARC does parametric insurance. But I remember, 15 years ago plus, when the Caribbean region being affected by tropical cyclones, etc., and those governments were really concerned about the fact that, you would have these events pass through the Caribbean and they'd never quite make the news unless the eastern seaboard of the United States was affected. And so there was a real question that they had in terms of how can we create some kind of a mechanism that would allow us to access some injection of liquidity to effect immediate response, with the appreciation that there is a longer term effort that's required to mobilize resources. And so there was this, we started to evaluate, look at parametric insurance. Again, speaking to transparency of triggers, you do the work beforehand, you use the satellite modeling, etc. When you have a category 5, if that's the basis of your contract, it triggers resources. The funds get to the government within 2 weeks of the event. They can effect response. And so that, I think, is presenting a lot of opportunity globally, especially when you think again about what we are seeing. It's not only in terms of tropical cyclones, earthquakes. You can look at magnitude in terms of shaking of the earth, in terms of its applicability. But I often feel like, a lot of times when we talk about innovation in the industry, we talk about it in the sense of products, and parametric is an important one. But there's also innovation in process, which is part of what I think you were alluding to, right? Innovation in terms of stepping outside of your comfort zone. If it is on the public sector side, to work with insurers to figure out how do you use the governance and the systems that exist to create efficiency within the system, right? And one innovation that we've actually seen is in the humanitarian space, where I think 2 years ago, the spending for humanitarian intervention globally was $64 billion US. That's a lot of money, right? Half of that was driven by climate weather events, earthquakes and things like that. But only 1.2% of that money is prearranged. So the majority of that money comes after the fact, right? Running around to say, okay, how do we get resources from here and there, right? But we've seen a shift. It's nowhere near where it needs to be. But that is also, I think, an opportunity where we can do more with the humanitarian community to look at insurance, look at the processes, look at the governance around how you manage risk, and then look at how do you use that dollar in a much more efficient way to actually drive greater resilience. So I just wanted to add that in terms of there is innovation in terms of product, parametric insurance, but let's also think about innovation in terms of governance systems and approaches, especially now.
Bennett?
Yes, well, tie those two things together. I think, no, what you said beforehand is very important, right? The risk management allows you to invest. And that's pretty straightforward and well understood in the private sector. To me, it's not really defensible. Why don't we apply the same to the public sector, right? And I'll give you an example. Most of publicly financed infrastructure in most countries around the world is not insured, including by development partners, by the World Bank down the street, by the regional development banks, by bilaterals. There's insurance doing construction, then it's handed over, and the government is left on their own to manage that risk. So that means most of it is not insured. So yes, you have this, to make it investable, it has to be insurable in the private sector, but why don't we apply the same to the public sector? And I think there's, to think about this different is what Ekosway was saying, is the process innovation. And one, for me, one of the most promising areas there is looking at embedded insurance, right? How can embedded insurance? How can we make it simpler now? We all know embedded insurance in your own life. We buy a flight and ask you, tick a box to pay $20 to insure that flight. Or you buy a new iPhone and says, pay Apple Care for $200 for a year. But it's way too complicated in the public sector in general, and whether we talk about infrastructure or other things, why can't we make that simple? How can we embed insurance into existing distribution channels? So that when you have a publicly financed project, let's say with a development partner, whether it's a multilateral or bilateral, a bank, basically have the tick boxes as, do you want insurance with that? Yes. I mean, it's a bit more complicated than a $20 flight, but we should think to get that simple, right? That it's not a separate process. You build the bridge, you build the port, then separately you start the 2-year procurement process. You probably didn't bring in your risk advisors at the beginning, so there are probably obvious things you didn't do that makes it uninsurable or too expensive to insure, and you spend another 6 months collecting data or doing some retrofits. So how can we bring all of this upfront, that insurance is part and parcel of planning, and part and parcel of all public investment planning? And I think that's something where I would like to see a lot more insurance. We've seen that, a lot of innovation. We've seen the examples in different sectors. We see it emerging, and development banks are looking more at saying, how can they bring insurance in? But I think there's a long way to go, but high leverage if we can get that right.
How do we take some of these ideas or some of the, I don't know, you mentioned like the 5-year pilots, right? And accelerate and expand on these in a way that's commensurate with the challenges that are hitting us globally? Where are the opportunities to scale more?
So I think you can just, also for people who don't spend their life in insurance, there's kind of 3 broad categories of how you could create something in insurance. There's kind of a facility, there's a product, and then there's really a structure of a market. And they work differently depending on how healthy the market is that you're engaging in. But they've all existed since the beginning, but they all have had recent innovations to meet the moment. So from a product perspective, you mentioned parametrics. So, the World Bank has been a partner on a variety of cat bonds in countries. And I think the interesting thing about that is when you do a cat bond, parametric is just by measure. That's really the definition of the word. And so if you hit a certain number on the Richter scale, you automatically get $60 million or $100 million, whatever the prearranged. And in many cases, in the case of Aon did a series of World Bank bonds in the Pacific Rim, is the government or the intermediating agency gets the money and they get to spend it how they want to spend it. And that gets to be also, I think, a cultural shift on this idea of dependency and independency, which is they know they're going to get it if it hits it, and they can spend it how they want. And then that goes from there. I think an even more interesting innovation on that product side is the Red Cross kind of stepped in this role in government and bought a traditional reinsurance product. And they had an amount of money for their own fundraising, but what they had determined was in moments of distress and severe events, if they had spent through their reserves, the dollar that they had to raise in a crisis was more expensive and less productive. And so if they got a layer of insurance instead of having to go out and do additional fundraising, that was better for them. And so they put a layer of reinsurance on top of that, very traditional product, new application. Some of the money came from the public sector, some of it came from the Red Cross. FCDO in the UK, as well as a German government fund, was part of that. And in the last year, it paid out in places like Sudan and Cote d'Ivoire and other many parts of the world, some of which really hadn't seen a lot of market activity in the past. And so you saw, a member of the nonprofit sector, this kind of in between the public and the private, step up and say, we're not able to do what we had been traditionally able to do. And that's on the product side. The next would be a facility, which is how do you create access to capital? I would offer the facility that was created in Ukraine, and that's political risk and not climate risk, although climate and conflict are intertwined. But that's where the DFC and the EBRD committed $100 million each into a fund. Now, no money has left either one of those institutions yet, but because it exists, the Ukrainian insurance companies on the ground can issue policies for war risk, property risk, a whole range of things, because they know that money is standing behind them. And so again, you may never have the DFC or the EBRD spend a dollar or whatever of money, but there's already $80 million in policies that have been written just off the DFC portion of the business. And so it's building a market. Ukrainian insurance companies are learning how to make the risk, to write it, to underwrite it, to pay out claims. But we don't even know if there'll be claims. They'll only pay out in the case of a claim. And the third would be where I think it's even further than that, and it's a market like you saw post 9/11, and in some other events, kind of like Pool Re, but after 9/11 in this country, there was no market for insurance for construction in New York City. A super healthy market, lots of demand, until the government, U.S. government came in and said, we'll pay up to a certain amount of first loss, and then after there's enough losses bared by the private sector, we'll pick up the top loss. So it created a box so the market knew what was the top and the bottom of what I'd ever have to pay. And the U.S. government neither pledged an amount of money, it was not scored, and there was no reserve set aside, but it existed and it created the structure, and that immediately flooded capacity into that market, and it's been moving ever since. TRIA will be re-renewed for the 4th time next year. And it's just that structure, and the private sector box has increased over time. But those product, facility, and kind of structure, those exist, and they can all be adapted to meet the moment.
It's interesting the mention of the role of the U.S. government coming in the New York City 9/11 context. I think things are in such flux right now in terms of U.S. engagement broadly, not just foreign aid, but U.S. engagement with regard to countries across the global south, and certainly with regard to foreign assistance and the foreign aid toolbox that the U.S. has traditionally used. And that's both on the bilateral and the multilateral side. All of it's sort of in question right now in the current tumult. But maybe within this moment, there's a way to think about a sort of what if. What if the U.S. government were to do more to leverage some of the things we're talking about here in terms of insurance to advance its foreign policy and international investments, right? We talked about the sake of efficiency, cost effectiveness, rapidity of response, even sort of putting forward a vociferous sort of model of development oriented towards the business sector and business sector stability and growth. What if the U.S. did that? If it did, what could that look like to you? Where should the U.S., if it wanted to go down that route, put some investment, put some backing? What would you like to see the U.S. do in this space?
I feel the need to intervene, not to be a wet noodle, but
wet noodles are welcome.
I don't think you have to look to the rest of the world to determine what the U.S. could do more of. I think we have to be extremely aware of what is being retracted right now. Mm-hmm. So the availability of weather data is the underpinning, about the NOAA data, but is the underpinning of enormous amounts on the industry. And there have been over 250 scientists and others that have been fired from NOAA, and we don't know what that is going to mean for the ongoing availability of data. There is a considered retraction of the U.S. involvement in the National Flood Insurance Program in this country to allow flood coverage for voters in the United States. And then there's a discussion of whether or not the government will reduce or remove its role from the housing system in Fannie and Freddie and the GSEs, the government-sponsored entities that allow, there was a reinsurance program created for the Fannie Mae and Freddie Mac after the financial crisis, because what it did is it said, we're going to create liquidity in the secondary market, which is what allows a lot of people to get a 30-year mortgage. That is a very uncharacteristic product that exists anywhere in the world except the United States. And if you don't have reinsurance, you have to shrink what is known as like the credit box. It's much harder to get a mortgage because you have to have better credit. It's a smaller group of people that can qualify. Whereas if you have reinsurance in case there's losses, you can be more expansive in who you can lend to. You know, if those get unwound and taken out of conservatorship and repaying back to the hedge funds. So I appreciate that we want to be aspirational.
Right,
But I also think like
it's
we
fair
need
enough.
to be aware of what's happening right now.
There's a list, and it's probably a long list, of things not to do and not to dismantle and not to take away. But there's also a list of things that could be done
Sure.
more. I mean, the Development Finance Corporation in recent years has built up some capacity to engage in political
Absolutely.
risk, and
Yeah.
they've used insurance structuring to support debt conversion activities in support of conservation, for example.
Right. So I'm just going to add to that the fact that what we should always bear in mind is that natural disasters are always paid for in one form or the other, right? They can be paid for by emergency aid, but emergency aid is a misnomer because on average it takes 18 months to raise money for an emergency, right? It's not me saying this, these are the facts. Then it gets paid for by the citizens that are affected in that particular country. It can be lower quality of life. It can be children that have been put out of school. It can also be some people paying ultimately with their own lives, right? Mm-hmm. Because the help is unable to get to them at the time that they need. So if you think about it from that perspective, right, that this is paid for in one way or the other, then the question to solve then becomes around what is the most efficient way to pay for it. And what I'm putting forward is that the pre-arranged financing model is much more effective than waiting for the event to happen. Because once you've arranged the financing in advance, it gives you then the space to plan for how that is going to be spent. It allows you also to compare what the actual expenditure was versus what the planned expenditure was, and to understand what drove the differences. And also, then when you're thinking about it from the U.S. government standpoint, I would say the U.S. government then should be encouraging this shift from the ex-ante type of financing, and then really moving the needle towards pre-arranged financing. Insurance is only one element of pre-arranged financing, but then we should know how a disaster is going to be paid for financially, and this needs to be all organized before the event event happened. I really liked then the example that you gave, because the funding aspect is an obvious one, just that the system needs to be financed. There are three elements that needs to be financed. The first one is, at least in the case of Africa, right? The starting point cannot be the insurance policy itself. There is a lot of preparatory work that needs to be done before a country can be ready for insurance. I think Ecosway mentioned part of it. The government needs to understand what the risk exposures are. You need to work with them in terms of what the structure is going to look like, etc. And at the end of this process, then you can have an insurance policy. The second part, which we haven't talked about a great deal, is around the subsidization of insurance premiums, because sometimes for developing countries, there are real trade-offs that have to be made between how a limited budget can be stretched. So if you have then some subsidies, it really helps governments be willing to spend more money on insurance. Then there is the third element, which is around capital, right? The amount of risk that you can take on via an insurance mechanism is a function of how much capital you have to be able to pay for the events. And not all the capital needs to be hard capital. And by hard capital, I mean money that you have in your vault ready to pay for insurance events. But it can be soft capital, as you mentioned, So a kind of guarantee mechanism where the government of the US can then say, in the event that there are losses that are above this point, then they will step in. This gives confidence to the market to be able to take on risk, knowing that there's somebody that will step in. But of course, there is also the possibility that they never have to write a check at all, because all the losses are absorbed by the market. But by signaling that they're willing to step in, they make the market function a lot more efficiently.
Let's take this opportunity to turn to the audience and engage a little bit more with questions coming from all of you. We do have a microphone that can be made available to you, so please wait until you're called on and you get the mic. But let's take some questions. I see one right here, and we'll take a couple together. So just there on the, yep. And please introduce yourself. Thank you.
Good afternoon, good morning. Can you hear me?
Yes.
Finally, yes. My name is Tegan Blaine, formerly of the U.S. Institute of Peace and USAID. One thing that I wanted to ask about was the opportunity for insurance models to work in fragile and conflict-affected countries, because there are a couple of examples that you've spoken about, for example, where Red Cross has used reinsurance to help provide disaster relief and so on. But at the same time, there's a lot of discussion about government's role in the insurance, in making insurance work. And so I am interested to hear your thoughts about whether there are models of insurance that can help support resilience and development in countries that are either conflict affected or emerging from conflict.
Thank you, Tegan. And we'll take this other question as well at the same time.
Thank you. Bob Eichert from the Atlantic Council. I work on energy issues, and one of my big concerns is the increasing impact of natural disasters on destroying electricity infrastructure. I mean, in the U.S., utilities budget a lot for losses. But in developing countries, because of the budget and the debt problems, they can't do that. And so, to me, I mean, I've IFIs, and I've worked some with MEGA and others on partial risk insurance and stuff like that. But that's mainly for private investment projects, right? So my question was, how do you see this, and how does your organization work with the IFIs, MEGA, regional development banks? And are there plans that they have to ramp up their insurance coverage bonds for those kinds of disasters that are affecting, I'm looking here from Southeast Asia, Philippines, I mean, has had mammoth destruction of their electricity grids from typhoons and stuff. And I guess finally the question is, given all the costs of these disasters, what's happening to premiums?
Great.
Maybe should I
Thank
jump in
you.
on the first one?
Yeah,
The
please.
question? So I think it is very possible in fragile economies or in conflict-oriented economies. And there's both Dave Brown and Luke Zanner are here, both of whom, Luke especially from the State Department, was instrumental in building what became the facility, the War Risk Insurance Facility in Ukraine. And I think the key thing is you have this fragility, so the market's unsteady. The existing insurance marketplace is unsteady. So what is going to be the ballast? What is going to be the stability that says there is going to be capital and you can rely on that capital to be paid? Because even, as you all know, in the most fragile economies, there's still a market that's trying to function and a desire for others to continue that market going forward. And so I think the presence of capital where people can rely on, if there is a claim, it will be paid, gives them the confidence to invest, draw down lending, but also invest their own money. And I think that becomes incredibly helpful. The second piece is the importance of using the local players to be a part of that system and not just have it constantly exported, both expertise and capital. It's okay if capital can come from the outside, but the expertise should be some sort of combination. But there's, I think, a variety of examples, and I think we're only going to see more of that because we've created volatility in our own, it's becoming more widespread. But I absolutely think that it's possible using both the traditional insurance products that I mentioned before and also some of these things around structuring. But it does require a steadfast partner in the public sector.
Maybe I can add to that. I mean, Bridget gave the example of Red Cross, but we've also done some work with WFP, World Food Program, right, in Syria, and providing a cover for people who are particularly exposed in that country, in that context. And so this is, I think, speaks to the point I was making earlier in terms of looking at non-traditional partners who are also present in in those contexts and seeing how they can use insurance to better support these communities. The second question that was raised was around ensuring energy, related to energy. So, part of the creation of the Insurance Development Forum was precisely to tackle this issue, which Benedict alluded to, right? You can have a situation where huge financing is going into infrastructure. I know of a scenario where a bridge was built, it was a big deal. Government ministers were there, they cut the ribbon. 2 weeks later, there was a flood, everything destroyed, right? And you still have to pay for that piece of infrastructure.
And not just that, the next step is the government borrows again to
exactly.
rebuild the same bridge.
Yeah, so this is a problem. Exactly, so this is a problem that we see. And part of the work that we have been doing within the Insurance Development Forum, also working with ARC, Aon, and others, is to make these issues explicit. And the fact that we can no longer have this sort of let's wait and see sort of approach, because it is a real issue for many developing countries. Some of the contributions that we've made is, for example, developing an industry view, responding to the governments on how they can approach insuring public assets. What is required if you are a government thinking about these issues? What does the market require from you to structure these things? It's also been particularly, I have to say, heartening over the last year. We have seen a bit more opening within the development banks to look at this issue, but we're nowhere where we need to be, right? And I think that this has to be a priority going forward, again, just given the current climate that we're in.
Benedict, did you want to jump in on this?
Yeah, just add on to this. And to your question specifically on what is happening maybe in IFIs and development banks, we are from CDF, we're having conversations, exploratory conversations, lobbying with whatever little influence we have to say exactly how can we shift that mindset and narrative. And it goes back to what we said before, right? How can we simplify the distribution of insurance and embed it, make it part of it? There is awareness, there is conversations, those institutions are complicated in their own right? There's many different political economies, bureaucracies, processes in place. They're risk averse for a good reason. They work with public money. They don't jump into something new very quickly. But I think these are some of the questions. I want to go back to your initial question. What could the US government do differently, either by influence or by financing? I think catalyzing some of those changes would be huge. Right. Leaning into it, that and when it's the World Bank, or you mentioned the Philippines, the Asian Development Bank, that every project, every piece of infrastructure is being financed, considers risk upfront, embeds insurance upfront, unless it's really not necessary when you do a risk assessment, but that it becomes part and parcel of the way of doing business. And I think that, yes, that requires just influence, leveraging the role as a shareholder, but it also requires maybe some financing, whether this means access to capital, access to a backstop, the governments are more comfortable, or in some cases subsidies to get the market going. And to some extent, I'd almost say then to your last point of the question, what happens to premiums? And Philippines, Eastern Seaboard, you mentioned a good example. Every typhoons, on average about 26 typhoons every year hit the Eastern Seaboard in the Philippines that destroy the energy infrastructures. It's the transmission lines, distribution lines are wooden sticks across the coast. They fall down very, very quickly, right? That is high risk. But to me, to some extent, the premium doesn't actually matter because, as Leslie said, somebody is paying for it. Right. So the government is paying for it anyway. The question is, can we structure that it's being paid more efficiently, more effectively, and ultimately paying less because you're not waiting for 2 months for electricity to come back. You're not losing that cold chain for your farm to market economy, whatever you might have, right? I think there's a huge
Can I just make one additional point? Sorry.
No, go ahead. And then what I'm going to do is I'm going to take one last question, and I'm going to warn you it's going to be like a speed round, both for the questioner and for the answerers. But go ahead.
No, there's a very salient point that Benedict made, which is get insurers involved in the beginning, not at the end.
Yes.
And oftentimes what happens is after the fact. So savings that could have been accrued through just advising governments on risk reduction actually doesn't happen, right? And for
Lower
me,
cost of
that's
capital.
Exactly, that's an incredible missed opportunity right now.
And please introduce yourself. Yeah.
Hi, Catherine Stahlberg, former Senior Risk Advisor at USAID. I've had the great honor of working with Echo Shui and Leslie for 5 years in that capacity with the U.S. government investing in the ARC system, and I was on the operating committee of the IDF. This is a cue for Leslie to speak on the innovations about multi-peril, multi-year policies in Djibouti, because I believe that's an innovation that the ARC system, it is a role model for CDRIF and CRIF and the others. Could I ask you to talk about that, and also about the disaster risk reduction? So when it comes to these expected disasters, these expected catastrophes, those year in and year out, hard to do disaster risk reduction strategies that the government at the national and subnational government level can do in Mozambique, Malawi, Djibouti, et cetera, makes that lasting difference as climate change and extreme weather events and future earthquakes, et cetera, are coming our way. So Leslie.
Thank you for the question.
Speed round. I'm feeling the pressure. So just on, I think as Benedict was mentioning, that there is a drive that we have for all of us on stage here to make actually insurance a lot simpler and easier. And one of the innovations that we have done at ARC is around creating multi-year and multi-peril insurance programs. So if you go to a government, in this case, the government of Djibouti, it's very tedious and time-consuming for them to then discuss their drought-related risk and then create a drought product, discuss their flood-related risk, create a flood product, discuss their hurricane risk, create a hurricane product. And if you have a one-year insurance program, which is typically the duration of the program, then you have this type of conversation every single year. So in fact, now then the approach is to bundle all those risks into one multi-peril product, and also make it a multi-year product, so that you have really one conversation and you're able to get efficiencies that way. And then it also links then to the point, I think, that Ekoswe was mentioning earlier, around the role of insurance in making the cost of risk transparent. Because when you have then a conversation with the government and you show them what it costs to insure a piece of infrastructure or business interruption, and they say that the premium is too high, it opens the door wide open to discuss what it would take to make the premium even lower. And then you can then at that point say, if you took these measures, then this would lower your premium. So this approach of pricing the risk helps to structure the conversation about what needs to be done to actually lower the risk in the long run. And without then the pricing of risk, it's impossible to have this conversation in a very structured and logical way.
Well, thank you. And thank you to you all for such a wonderful conversation. We could keep going, but I want to be respectful of people's time. And it's time now for people to mingle and network over lunch. But please join me in thanking this excellent panel.